On Friday, Apple lost about 7% of its value in a single session, and almost every headline told you the same story. Demand, iPhones, China, consumers pulling back. Here's the thing, Apple didn't miss. Apple got outbid, and the company that outbid it doesn't sell phones. It doesn't sell anything you can hold. Let me show you what actually happened because it is a far more interesting story than the one you got. Start with the scene of the crime, Apple reported. The quarter itself was fine. iPhone revenue was up. China was recovering. If you only read the results, you'd have expected the stock to be flat or higher. Then management gave guidance for the current quarter, and the stock fell out of bed. So, what was in the guidance? Not a demand warning, a supply warning. Apple told investors it cannot get enough components. And then came the pile-on. Within hours, the read was everywhere. Apple's growth story is over. The consumer is tapped out. Peak iPhone, again, for the 9th year running. It's a comfortable story because it's the story people have been waiting to tell about Apple for a decade. There's just one problem with it. It is not what Apple said. A company that cannot get parts and a company that cannot find customers look identical in the share price and are opposite in every other way. Except, Apple didn't lose customers. It lost an auction to a data center. And once you see the auction, you cannot unsee it, because it explains almost everything strange about this market right now. Here's the mechanism, and it's simpler than you'd think. Memory chips are close to a commodity. There is roughly one global pool of capacity made by a small handful of companies, and everybody bids for the same bits. Your phone needs memory, your laptop needs memory, and an artificial intelligence server needs an enormous amount of it. Far more per unit than any consumer device, and the very highest performance kind. So when the data center build-out accelerated, the memory makers had a choice about where to send their capacity. They sent it to the buyer paying more. That buyer was not Apple. Now, look at what that did to prices. Conventional memory contract prices rose as much as 95% quarter over quarter in the first quarter of this year. Then another 58 to 63% in the second. Flash storage contracts rose as much as 75% in the second quarter alone. Gartner models memory prices up around 130% year over year for 2026. That is not a normal cycle. That is an auction with a bidder who does not care what things used to cost. And the obvious question is, why not just make more? Because you can't, not quickly. A memory fabrication plant is a multi-year, multi-billion-dollar construction project, and the industry spent years being punished for overbuilding. Meaningful new capacity isn't expected to arrive until late 2027 at the earliest. Micron has told the market it expects the shortage to persist through 2027. So between now and then, this isn't a supply problem that gets solved. It's an allocation problem that gets decided. Every quarter, someone chooses who gets the bits. And the people making that choice are looking at who pays more per gigabit. And here's the kicker, the detail that turns this from a story into a signal. Apple saw it coming. Apple locked in flash storage supply ahead of the price spike. Exactly what the best supply chain operator on Earth is supposed to do. And it still had to warn. It has already raised iPad and MacBook prices, and it said out loud that the reason is memory and storage costs driven by the data center build-out. Think about what that means. The company with the most cash, the most leverage over suppliers, and 25 years of supply chain mastery planned ahead and still got outbid. Now let me give you the honest risk in this read, because it's real. If memory stays this expensive, device makers pass it on, and there is a limit to what people will pay for a phone or a laptop. Higher prices can genuinely break demand. And if that happens, the bearish take on Apple ends up right, just for a completely different reason than the one being given. There's a second risk too. Auctions end. If the build-out slows, the bid disappears fast, and memory is famous for going from shortage to glut in about 2 quarters. This read is a statement about the next several quarters. It is not a prediction about forever. But here's the payoff, and it's the part that makes this asymmetric. All through July, the market was busy marking artificial intelligence infrastructure down. A fund running 4 times leverage got liquidated. Semiconductor indices fell more than 28% from their June peak. The narrative was, the bubble is deflating. And in the very same window, Amazon raised its capital spending plan for this year toward $220 billion, reported cloud growth near 37% at a 39% operating margin, and disclosed a backlog around $496 billion. The financing of the trade got marked down. The physical demand didn't move. And the proof isn't in a slide deck, it's in Apple's guidance. So here's the call. And it's falsifiable, which is the only kind worth making. The memory bid does not break before 2027. If conventional memory contract prices post a single quarter-over-quarter decline between now and the first quarter of that year, I'm wrong, and you should hold me to it. That's the number to watch. Not the headlines about whether artificial intelligence is a bubble. Not the share price on any given Friday. The contract price of a gigabit of memory, quarter by quarter, is the cleanest read on whether the buildout is still winning the auction. Apple didn't miss. Apple got outbid by a customer that doesn't buy phones, doesn't care what memory used to cost, and isn't going away before 2027. The market read that as bad news for the artificial intelligence trade. I think it's the strongest evidence yet that the demand is real. So what do you think? Is a supply warning from Apple bearish for Apple, or bullish for everything doing the outbidding? Tell me in the comments because I genuinely go back and forth on it. Today's full daily brief is linked below. I am Frankie, the asymmetric signal, one contrarian read a day. Subscribe. Research and education only, never investment advice.